Dumb money is all in on the stock market today, with the largest number of investors bullish on US stocks since late 2021. Just over the last 50 trading sessions, investors have been getting more and more bullish on the stock market, now reaching higher levels of complacency than December of 2021, just a couple of months before the stock market began a 25% drop. This line that you see here is a simple survey that asks investors whether they are bullish or bearish on the stock market. And since 2007, we've seen this vary up and down. But when we add the stock market on top, we see that moments when investors were very optimistic on the stock market often coincided with significant market peaks occurring before several substantial market corrections, including the 2008 financial crisis. We're going to see what this extreme optimism means today for investors that want to be smart money, what it means in terms of timing the stock market, and I'm also going to show you a rare signal that just occurred that's giving the US stock market today a very 1987 vibe. When so many investors are bullish on the stock market, smart money typically gets defensive and begins to scale back their exposure to stocks. And the opposite is true when many investors are getting pessimistic on the stock market, like in these instances right here. Those are the moments when smart money wants to buy stocks at a discount. We saw this in real time in 2022. The stock market was going down aggressively. The S&P 500 was down about 25% from its all-time high. And when you look at investor sentiment, people were absurdly pessimistic on the stock market. In June and September of 2022, we were recommending our clients to buy stocks with both hands for the long run because these were levels that investors were not going to see again for a long time. Many people thought we were completely out of our minds, and some even actually unsubscribed to our service because they didn't agree with this view. Now, with the S&P 500 rallying 50% from its September low, investor sentiment completely turning around from this extreme pessimism in 2022 to extreme optimism in 2024, is it once again time to be contrarian and think about scaling back our exposure to the stock market? The way that contrarian investing works is that if most people are fearful or pessimistic on the stock market, it probably means they're willing to sell their stocks at a cheaper price than what they're worth. When most investors are very optimistic, they're probably willing to buy stocks from you at a premium. The rational contrarian investor can take advantage of both of these fearful and greedy markets. Today, with the price of the stock market at much more elevated levels and investor sentiment getting more and more optimistic, we're definitely not recommending our clients to buy stocks with both hands for the long run like we did in 2022. In fact, investors with a long-term investment horizon should probably be thinking about building cash at these levels. Now, unfortunately, contrarian investing is not the greatest way to time the market perfectly. In May of 2021, for example, investors were already extremely bullish on the stock market, but it wasn't until January of 2022 that the stock market actually peaked, so 8 months later. So a contrarian investor would have missed out on these 8 months of gains. Now, eventually, they would have been able to buy the stock market at a much lower level than what they sold them for. So that's what we're telling our clients today. Our strategy is much more of a day-by-day approach for traders and investors that want to continue riding this bull market as long as the price action and the macro environment remain bullish. Or in other words, as long as financial markets remain risk on. We just saw the S&P 500 bounce off its 100-day moving average and off a key price channel that we repeated many times would provide a huge buying opportunity for investors. But it's not just the price action of the S&P 500 that's risk on today. We're also seeing signals from the rest of the market that suggest we're still in that type of environment. You may not have heard of it, but this is one of the most powerful risk-on indicators for the stock market. It's the gold to silver ratio that just triggered a very rare signal. We recently saw a huge breakdown of this gold to silver ratio, which means that silver is outperforming gold substantially. Now, this breakdown tells us a lot about how precious metals investors are feeling about the market. Everyone knows that gold is a safe haven. It protects you from any sort of risk in financial markets. Silver, on the other hand, is a lot more volatile than gold. It goes up and down much more aggressively. So precious metal investors flock to gold when they're feeling less confident about financial markets, and they flock to silver when they're feeling very confident about financial markets. And so that's why this breakdown is so important, because it's telling us that precious metal investors today are confident about financial markets. Now, don't worry, I can prove my point. I've highlighted 3 moments here on this chart where the gold to silver ratio did something very similar to what's going on today. When I add the S&P 500, you can see these breakdowns in the gold to silver ratio happen to be followed by large moves up in the market. So we can say that these breakdowns are risk-on signals. And we can go back further in history as well. All of the breakdowns that you see on this chart are similar to the one we have today. And all of them were followed by significant rallies over the next few months, and in some instances, years. But there is one problem that makes today different from all of these instances that you see here. Today, as I showed you at the beginning of the video, investors are optimistic on the stock market. Most of these breakdowns that have occurred on the gold to silver ratio happened when most investors were not optimistic on the stock market. In 2020, they were not optimistic with an ongoing pandemic. In 2016, they were not optimistic. In 2010 and 2003, they were definitely not optimistic like they are today. Many of these breakdowns in the gold to silver ratio occurred after significant drops on the stock market that damaged investor psychology. All of them except for one. 1987. This is a moment in history that we've compared many times to today in recent videos because of how many similarities there are. We can see this breakdown in the gold to silver ratio also occurred after the stock market had already rallied significantly. That's very similar to today. Now, the signal did work. The market moved up by 15% over the 3 months that followed, but you can also see that contrarian investors were eventually proved right. The extreme optimism eventually turned into extreme fear, completely retracing the entire 1987 rally in just a couple of weeks. Today, however crazy this may sound, how ridiculous valuations are, how overextended the stock market is, we are in a risk-on environment. This, so far in 2024, did allow us to make some great trades, with many of our trades this year yielding high double-digit returns. You can check out our closed trades for 2024 on our landing page at Game of Trades. Our goal is to make sure that we'll continue making these types of trades throughout the rest of the year, although unfortunately, there's no way that we can guarantee this.